There we go. So now we all know where we are, and I will hand over to James. So as I say, huge thank you for coming along today and preparing this. I've seen the presentation in advance, and there's lots of top detail in there. So really looking forward to this on a personal level as well as obviously as part of the process. But yeah, I'll hand over to you and take it away.
Cool, Robbie. Thank you very much. So everybody, I will try and give you a roller coaster of a session, a white knuckle ride on something that can be a really dry topic. Just to let you know who I am not a lawyer, I am not an accountant, I am not qualified in any way. I am a lifelong entrepreneur that spent my time tearing my hair out with the professionals that should have been advising me. I've lived and breathed everything I'm about to tell you about. And my frustrations eventually led to me setting up this business, which is now a fully regulated law firm, a fully fledged accountancy firm, and we deal with about 400 SMEs from cradle right the way up to exit, whatever that exit may be. So I do live and breathe everything I'm about to talk to you about. And I want to start with a really topical example of why hopefully the next 20 minutes odd are so topical. And that's OnlyFans. And don't worry, I'm not about to tear off all my clothes and suddenly find that I've come to the wrong presentation. So OnlyFans was actually the first British unicorn. It's been in the news a lot. It was intended to allow people to speak directly to their fan base. And ultimately, it's ended up providing sort of services inadvertently that are slightly more along the lines of hardcore porn. So OnlyFans, some people on it are straight-laced celebrities or people just trying to reach out to their fan bases. Other people are simply taking their clothes off. And somebody should have sat down with OnlyFans right at the start and said, how do you see your services being used? And is there a possibility that they might end up in different niches or even conflicting? And the minute they said, yes, there is, they should have looked at structuring that business so that it can service the different sides of its clientele effectively, cleanly, and without them coming into conflict. And the trouble that OnlyFans is having at the moment, unless you're a complete cynic like me and you think it's all about pushing up their share price, is basically because they weren't advised properly and told to structure their business in the right way. So, get my presentation frozen.
Are the arrow buttons doing anything?
Nope. I can carry on with and share it later and cut back into it if it suddenly starts working.
I should be able to share the slides from my end. So carry on, and we'll work something out.
Great, and luckily I have a paper copy here because I'm an absolute dinosaur and sort of dread that this may happen. So many entrepreneurs and so many of the people that we see and so many of our clients, they just advise badly when they form their companies. And going right back to OnlyFans, somebody sat there and said, I've got a great idea for a website. And somebody should have spoken to them and said, this is what you need to do. And it's really all about how people envisage their businesses unfolding, where they think they're going to be doing business, and how that business is likely to need to be sold, changed, or moved around along the way. If you don't get it right from the start, it becomes more and more complex to change as you carry on. Why? Because you're adding shareholders into the mix, you're signing contracts, and those things aren't easy to move around into a new structure. So if you don't get it right, it can make it hard to adapt your business to change. It can fuel risk for your investors, and I'll touch on that in a second. It can massively increase your tax liabilities, and this is one thing that a lot of people really overlook. Most importantly, for most of you, probably, it will fail to ensure you're properly protected as founders. And it's not just about getting the structure right at the beginning. The structure needs to be looked at all the way through to make sure that it's continuing to do what you need it to do to fuel the growth in your business and keep your business growing as it should be. So there's various building blocks of value. So whether you're creating, scaling, or selling a business, there's some common elements which drive enterprise value, all of which tend to be influenced or are dictated by your company structure. I'm going to touch on all of those over the next few minutes. They include money, how you're funded, and where you're spending your money, Documentation, which basically is what is your structure, how does it function legally, and how are you going to describe it to other people? The structure itself, assets and IP, what do you own of value and where does it sit within your business? People, which bit of your business are they working for, and do they understand what they're supposed to be doing? And then the advice that underpins all of this, and then most importantly, you, the business owners, the entrepreneurs, what are you trying to get out of this, and where do you envisage your business going, and are you going to be protected along that way to maximize what you want to get out of it? So before your money comes in, we'll start on money, and really this is the most important thing. Most people only think about their company structure for the first time when they go out to raise investment. And that's probably the first time they ever seek advice on it. It's probably the first time they look at any of the other things on this list: documentation, structure, assets, and IP, people. And when you go out to raise money, there's a window of opportunity before you start to set out those corporate documents, before you do your shareholders agreement, so that you can really get the structure right before you present it to other people. Why is it a window of opportunity? Because it is the last time where you will have carte blanche to do whatever you want with the rules and regulations on which your business runs. It is the last time before you can structure your business however you want, before you allow third parties, investors into it, who will then have a say in the future and potentially can put the brakes on any plans you have in the future. So you need to look at where the investment is going to come from and what they want out of the structure in your business. Friends and family tend to be much more supportive. They won't really look at the structure. Angels as well often rarely look at the structure of a business, and VCs will dictate the structure of your business and will come in and say, this is what it has to look like, and this is what it has to smell like. You're going to need to start thinking about whether you want to raise money under SEIS or EIS, because that will dictate the structure of your business. It will dictate how you set out the classes of share that people will buy, how the money comes into the business, and how you treat those shareholders. And most importantly, it doesn't matter what percentage you're giving away. Even if you're giving 1% away, the minute you've given that 1% away, that is somebody that you've got to negotiate with if you want to make any changes in the future. So it's crucial that you get the structure right before you bring any investment on board, but that you don't treat it as just a one-hit wonder. You don't just go out and get advice once and think, great, that's done. It's something that you need to keep paying attention to throughout the lifespan of your business, because it's the structure of your business that is your shop window that is going to make people buy it or not when you come to exit. And then more importantly, after you first go out and raise money, there is a honeymoon period during which you can still implement some changes, but after that, you will have to evidence why you want to change the structure of the business. You will probably have to do it against your ability or your failure to reach milestones that you promised your investors. And more importantly, any change you want to make will have to be evidenced against the value that's likely to deliver to your investors, either at the next investment round or at the next investor event. So the most important thing when you're looking at structure is documentation. And this is something that is overlooked by so many business owners. When you become a director of somebody else's business, you very rarely read the articles of association or the shareholders agreement. Most investors that we deal with, and there's many thousands of them, rarely read any of the documentation that underpins their investment. And annoyingly, most people, when they go out and get legal advice, tend never to get a holistic explanation of what all the different documents do. They just get somebody drafting a shareholders agreement for them that they may never read, that all their investors will never read. So by the time it becomes very important, when millions could be riding on it, you've got an untested document that hasn't been properly thought through, that basically defines the value of your business. So apologies if I'm teaching you to suck eggs, but I'll be super quick. The articles of association are basically the law on which your company sits. In America, they're much more appropriately called the bylaws. The shareholders agreement is a contract between the shareholders. If you breach the articles of association, that act has effectively never happened. It hasn't happened legally, it has never happened. If you breach the shareholders agreement, it is a breach of contract between the shareholders, that if one of the shareholders suffers a loss because of it, They may choose to sue you or to sue the company. They're very, very different documents. The Articles of Association are a public document. They go on a company's house. They can be changed with a vote of 75% of shares held. The Shareholders Agreement is a private document and can only be changed with the consent of all of the signatories unless there is another mechanism in there to change it. Very, very important to understand the difference between the two. The Articles of Association should establish the principles on which you wish to run your business in greater detail than those set out in the Companies Act. Your Shareholders Agreement is effectively a prenup on steroids. What it is there to tell you is what happens if I want to sell my shares, what happens if I fall out with you, what happens if I want to fire an employee who's also a shareholder, and what restrictions am I going to place on my shareholders. Think of it as a prenup. And that's why it is so important, particularly between founders of businesses. All of their interests should be comprehensively addressed in the Shareholders Agreement. So, as I said, investors rarely read the documentation, which makes it all the more important that you read it and get it right before you send it out to them. One of the key things, Articles of Association can be changed by 75% vote. What that means is that somebody not bothering to reply to your emails saying, can we change them, doesn't necessarily hold up the whole process. Most lawyer drafted shareholders agreements need unanimity. Everyone has to give their permission for any change. And that can be fatal if you're trying to make reasonable changes and one tiny shareholder can't be bothered to respond. So one of the key things you have to think about all the way through is, will these documents see me right the way through to an exit? And if they won't, how can I change them? Can I force shareholders, especially tiny shareholders, to accept reasonable amends to these documents? And that's a problem that a lawyer will very rarely ask you when they're founding them. The default in a shareholders agreement is that it needs unanimity. I would strongly advise you never have a shareholders agreement that needs unanimity. The next bit is founders. If you are the founder of a business, or if you are the owner of a business and you are about to take on investment, you are about to give other people ownership of your business. So there's about to be more owners. This is the last time that you can build in specific protections and entitlements for you, because once you have someone else in your business, they will almost never allow you to make those steps, no matter how reasonable. So what kind of things should you be building in before anyone else comes near ownership of your business? You might want a veto over things passed by the board. You might want to control who goes on the board. You might want the right to appoint additional directors so that you can't be outvoted. If these things are put in at the start, they are rarely questioned by investors. But in my experience, you will never, ever get them in once the investors are already in, because why would they give you that authority if you don't have it in the first place? Really, really reasonable basic stuff can go in, like shareholders not being able to pass a resolution without certain provisions. Abilities to appoint extra members of the board. You need that in from the start. So, next bit, most of you will probably have heard of drag and tag clauses, drag along and tag along. What does that mean? Drag along, and again, forgive me if I'm teaching you to suck eggs, drag along is if the majority of the business want to do something, they can force or sell the business, they can force the minority, tiny shareholders to come along. So in other words, somebody with 1% can't block a sale of the business by 99%. Tag along entitles the tiny ones to come along with the majority. So if I want to buy your business, why would I pay for the whole lot if I can just buy 51% of it? Tag along enables the 49% to say, we want the same thing that the 51% are getting, and we're going to tag along with that deal. These clauses are nearly always put into shareholders agreements, but what they almost never cover is restructures. So if you want to move your shareholders up into a holding company, and I'll come on to why you will always need to do that shortly, does your drag and tag along provisions allow you to do that? Very rarely do they, because lawyers generally only consider these clauses in an exit. You need to make sure that they cover a restructure or reasonable, and that's a wonderful word for contracts because it's the sort of cure-all, but cover reasonable changes to your business. Likewise, IP. If you own IP, where does it sit? And most importantly, and this applies to employment contracts as well, if anyone else creates IP, are they giving it over to the business? You need to have a clause in your shareholders agreement and in every other piece of applicable and appropriate documentation that means that any IP that is created is assigned over to the business and doesn't sit with the individuals who've been creating it. The next bit is members of staff. Now, if you are a founder, or especially in a startup, and you want to give shares to members of your staff, there's two big questions, and lawyers will never ask them. The first one is, should you be giving them shares? Because most normal members of staff would much prefer free beers on a Friday night, and share schemes are expensive. There's lots of paperwork, and most normal employees don't bother to read it. It's a nice to have, but it will rarely sway their motivations one way or the other. So my argument is only give shares to people, senior managers, people that can really change the destiny of your business, where they're going to get a lot of value from it, and it's really, really going to motivate them. Otherwise, there's much better nice to haves for your normal members of staff. The next question is, lawyers love option schemes. Why? Because they're expensive. You have to value the business. You have to have separate option agreements. You have to have a plan, loads and loads of nice bits of paperwork that they can download as templates, change a few details and charge you a fortune. Options in some cases are the right way to do it, especially for senior managers that come in when there's already value in the business and you want to reward them for what they're doing. If somebody comes in right at the start, especially when there's no value in the business, you're almost always better giving them shares and building a clawback into the shareholders agreement. So what that means is they feel ownership, they feel like they've got something. But if they don't perform or hit the same milestones that you'd put in an option agreement, you can take those shares back off them. It's much more tax efficient, it's much cheaper for you, and it's actually a better result because your key people are absolutely bought in from the start. And the last thing I'd say on options is everybody loves to give them out, but be really, really careful about a member of staff who is vital to you now, but will be a sheet anchor in a year's time and can't afford to leave because their options have become too valuable. Always a problem in rapidly growing companies. And then the next bit in shareholders agreements and any other thing is look out for things like consents, vetoes, misconduct, vesting, and SEIS. So one of the things that venture capitalists love to do to get shackles on you is put consent matters into your shareholders agreement where you have to get their permission to do certain things. Now, these are generally reasonable, and especially if they're trusting you with millions of pounds of their money. But one of the things many of you will have found if you ever get investment from VCs is that they have a very limited focus. They're investing in hundreds of businesses a year sometimes, and they're only able to focus on a few of them. So your urgent, desperate need to get their permission to do something often will not get a response and can take months. So little things like build in that they must respond within a reasonable time frame. Otherwise, you will assume the answer is positive. We talked about vetoes, basic vetoes for the founders before you take on shareholders. Misconduct. Increasingly and often, we see founders that are evicted from their business, sometimes with trumped up misconduct clauses. And that gross misconduct clause is used to remove their shares off them, which is almost always a standard clause in a template. So if you are the owner or founder of a business, do you really want your ownership of the business taken off you by a venture capitalist because you have been fired for gross misconduct? That could be 2 years while you wait for a tribunal where you have no control or input into the business you have built. And by that point, it will be almost impossible for you to take control back. Be very, very careful with supposedly standard clauses in documentation supplied by most lawyers. Vesting, reverse vesting, is where essentially you hand over ownership of your business to your investors. And if you hit certain milestones, you get more and more shares back. Now, if you're just a manager being brought in to run somebody else's business, that's totally fair. But if you've had an idea, and particularly if the business is already trading and doing well, that is outrageous. And you should refuse that and be very, very cautious about any investor that suggests it. And the last one is SEIS and EIS, essentials for investment into any business. You have to structure the business accordingly. Otherwise, it may not be eligible. And it's very, very easy to tweak documentation or to see your business develop in directions or ways that suddenly renders you ineligible. Some professionals will get you over the initial hurdle. Very few will keep a watching brief. And that's exactly what you need if SEIS and EIS is going to be handled successfully. Otherwise, you'll find yourself having to compensate shareholders, not just for the loss of the tax benefit on the way in, but potentially for the loss of the tax benefit on the way out. And believe you me, that can paralyze and often kill the sale of a business. So we've had a quick look at the documents. Now you need to think about future considerations, because all the documents will generally deal with is your business as it is now. You need to future-proof your company as far as you possibly can do. And with this, you don't need a crystal ball. You just need to think about your business. If your business is a sweet shop in a small town and you have no ambitions to go anywhere else, it's probably okay just to have your business as one limited company that does everything, that keeps your logo, that keeps your intellectual property, that keeps your recipes, that does your sales, that does your employment, that does everything else. However, if the big sweet shop owns the building it's in, you almost certainly need a holding company and an operating company. Why? Because if the operating company gets into trouble, you don't want to lose your asset, which is the building. People think that a holding company or a group structure is something that you shouldn't touch unless you're a PLC, because it's expensive and cumbersome. But it really, really isn't. And if your accountants or advisors are making it expensive and cumbersome, you're with the wrong advisors. Going back to the OnlyFans example, they almost certainly should have had 3 different trading subsidiaries. One which handled the adult material, one that handled what they set themselves up to do, which was contact with your fans, and one potentially that deals with the more Hollywood side of their business that they're trying to break into now. They probably should also have had a development arm that develops their software for them, and maybe a non-trading subsidiary that holds all of their intellectual property. Why? Because then somebody, for example, if they wanted to sell the adult content because it's getting too hot to handle, they can just cut that limb of the tree off and sell it straight away without any complications or without moving things around. So look at your own business. Do you think you might one day need to trade overseas? Do you think you might one day start to get into business with another company and form a joint venture? Do you think that you might one day start selling pears as well as apples and start to develop pears and might want to license that software or development know-how out? Do you have assets? It might be a building, it might be intellectual property. And do you have risks? Could you lose everything if a member of staff fell over and broke their back and sued you and your insurance said you're not covered? If the answer to any of those is yes, then you most certainly should be looking at a slightly more sophisticated company structure, such as a holding company and trading subsidiaries. And it's much, much easier to put that in place right at the start than it is later on. You'll generally only consider this when the writ comes through the door, or when somebody wants to buy a chunk of your business, or when you're trying to sell it. By that point, you're having to move shareholders around, move all of these different issues into the correct silo. You're having to get clearance from HMRC for each thing, and it becomes very, very expensive. So think about how you see your business developing. It is absolutely crucial to try and future-proof it, and will save you a fortune. So, as I said to you, anyone other than the sweet shop in a county should probably be looking at some form of holding or group structure. And all that means is that you have one company that owns another company. At its most basic level, what that means is that your shareholders come into a company that doesn't trade, that holds your assets, and you separate out the trading risk, your employees, your contracts and other things down into an operating subsidiary. You can do group accounts and file with HMRC as if they were all one thing. But what it does is it firewalls the risks of doing business from the value you're creating. And that's really essential. So it enables you also, it makes it much easier to calculate tax, also to set aside a development arm if, for example, you're a software company and one of the big things you do is development, and to calculate R&D. You can protect the entrepreneur by making sure that all the value flows into the holding company, and the holding company is where their control is exerted rather than on the subsidiaries underneath. It gives you the flexibility to license stuff out or create special purpose vehicles like joint ventures. So if you want to go into partnership with another company, you just create another company to do it underneath. It protects you against commercial risks. On this little diagram, if an employee in subsidiary 1 gets into trouble, or say it gets into trading difficulties and you need to close it down, you need to liquidate it, you haven't lost the IP in the holding company or subsidiary 2 or subsidiary 3. So let's go back to our sweet shop. They decide to grow. They want to become a national chain. They have 3 sweet shops. They've got subsidiary 1, subsidiary 2, subsidiary 3, 3 shops. And the leases to all shops sit in the holding company, or the mortgages. Their IP sits in the holding company. If one of the shops stops doing so well, they can close it down and liquidate that business without damaging the rest of the structure. You cannot do that if you only have everything in one company. So it enables you to silo issues. It also protects the shareholders' long-term interests, including your own. Why? Going back to that example I had, instead of the shareholders investing in a company that was dragged down by one bad decision, you can chop off the bad decision and protect the good bits of it. And it gives you much, much greater flexibility on exit. So let's go back to that terrible example of OnlyFans. 3 different silos, 1 for adult material, 1 for fan material, and 1 for a growing Hollywood celeb platform. They may want to sell the adult material one because it's bringing reputational risk to the others. It may be the most valuable thing they have, and they decide to sell it before they get into trouble. So it gives you a lot more flexibility on exit. Or say somebody buys it and says, but I don't want the adult bit, you could chop that off, either sell it off or close it down. It gives you choices that you don't have if it's all in the same vehicle. And that's even more important when it comes to the members of staff that work there. You're not consistently trying to separate out bits of one big mess. So this will also, if you get this right, will really, really maximize the value of your corporate structure in a number of ways. It enables you to maintain the corporate veil. Now, what's the corporate veil? It's a legal phrase that basically establishes the difference between shareholders and directors. And we all know that if a shareholder gets too active in a business, they can become inadvertently liable as a shadow director. We know that if you're a director of one company and start to interfere in another, you also can become a shadow director for that and personally liable for the debts of that company. So rather than one business where everybody is involved in all of the business, you can separate it out into the structure I've just showed you to protect the participants in each part of the business. And that might include you as you run the business through the holding company. It is also a reason why you need to consistently check the structure to make sure it's healthy and being well maintained. Why? Because if you go to all the trouble of creating a group structure and run it as just one company, what have you done? You're treating it as one business, which means it's much, much harder to then pretend that a part of it you want to close down was separate. So it's very important to respect and maintain the structure to maintain the corporate veil. As I've said, it's not expensive to do. You can file group accounts and VAT and run it all on the same accounting systems. But the key thing is that you can report on them both separately as and when you need to be able to do so. A lot of people get this right and then screw it up. Why? Because they treat different companies as the same thing. And I want to give you one example on intercompany loans, because this is one we hit again and again and again. You have somebody who wants to buy a pub, and they create a holding company to own the pub, and then they create an operating company underneath to operate the pub. That is good advice. Why? Because if the operating company gets into trouble, they don't lose the pub. Everything sets off well, but the operating company starts to pay the mortgage. And most accountants will show it paying the mortgage because that's where the money comes from, and they're lazy. So what do you have if the operating company gets into trouble? You have the operating company owed a lot of money by the holding company for the payments it has made on the mortgage. So when the pub owner goes back, tries to close down the operating company, he finds that the liquidator is taking out the holding company as well because of all the payments the operating company made on the mortgage. The pub owner will get a bill for the whole lot. What should the accountant be doing? You should put in place a very basic rental agreement from the holding company down to the operating company, and the accountant should be showing that the operating company is paying rent up to the holding company that is then paying its own mortgage. Problem solved by 2 small pieces of paperwork and a flick of the accountant's pen. But very, very few people get this right. And I give you that as an example to how easy it is to maintain the structure, but also how easy it is to get it wrong. And that's why it's very, very important that this structure is maintained. The better it is run, the better it is maintained, the more credible it is, the more value your business will have on an exit, particularly when you come to things like EMI, when you're giving out options to employees. Where is the employee employed? Are they employed in the right part of the structure? Are they incentivized to perform in the right part of the structure? EIS, have you grown your business in a way that accidentally has made you ineligible? Have you created a joint venture that is now more than 50% owned by someone else that can cause a problem? You need to make sure that your advisors are advising you consistently, not just as a one-hit wonder before the money comes in. So now onto your people. And you could spend hours and hours on people alone. So I'm really just going to cover this from a structural perspective, that, as we all know, your business is only as good as the people in it. So when you hire people from a structural point of view, be realistic about what they can achieve. One of the biggest problems we see in all small businesses is somebody hired as the second coming of Christ in year 1 is generally out of their depth and the sheet anchor at the end of year 2. They've been overloaded, they're sometimes underpaid, but they're often unable to leave because of their options. Be really, really cautious about who you hire. And always remember that you will probably have to replace them within 1 to 2 years if your business grows as planned. And you need to structure your company and particularly any equity incentives accordingly. So factor risk and accountability into your structure from the outset. What is this person wanting to do? What have I hired them to do? Really importantly, can I hire in above them? And are they incentivized to support that? And also, just as importantly, can I get rid of them? The next one is, do they need equity? And I've touched on this already. So many people throw out options like jelly babies to every member of staff, leaving themselves with a really expensive hangover because they then have to maintain the scheme. Very few members of staff are incentivized by or need equity. As I've said, often it's more efficient by giving them some shares with a clawback, but key questions like, can I dilute them down? Don't give them a percentage of the company, you have to give them a number of shares. Do they need equity? What are the milestones they're going to be performing against? And always remember what happens if this person starts failing or if I need to replace them, which is much, much more likely than them walking out on you. They need to be able to afford to leave, and that's a key thing. And always just keep checking yourself. Are options sensible? So many of the small businesses we will deal with did the right thing. They went to a lawyer or an accountant and said, I want to incentivize my staff. They got given a textbook template for share options that really nobody's bothered to look at this business, what's likely to happen to it, what bumps in the road it's going to hit, and where it really wants to go. And that's what a really good share scheme should underpin. So I've touched a little bit on advisors. So we're going to move on. Most small businesses fail within 2 years. Why do they fail? Basically because the owner of the business stops doing what they're good at. Good example, let's take an architect who his business starts growing. Suddenly, rather than being a successful architect, he's running a successful architecture practice, which he's not very good at. So the business fails. Businesses need multiple inputs. I'm not going to go through all of them. Most people have a dream of an amazing board of directors, which you will rarely ever achieve until you become a PLC. So you need to go out and get advice. That means all of us must be much, much more aware of the limitations of the professionals that we rely on and their ability to advise us. So there's massive, massive problems with professional advice. And we hit these time and time again. And this is why I set up my business. Most professionals are uniquely and peculiarly unqualified to help you and give you the advice you need. And I'm not just bashing them or being unfair to them. This is because almost none of them have actually been in or run a business of their own. And if they have, it's a partnership, which is nothing like most of your businesses. They're trained to be risk averse. You are by definition trying to take a risk. They are terrible at diagnosis. So often when you go in to get an employment contract drawn up, they should be saying, what is this person doing? How could the role change? What does your business do? How could your business change? Generally, you will get the same template they gave everyone else because they're not equipped or trained to ask you questions about your business. They will only focus on the legal realities of that person's employment. Their advice is incredibly siloed. Most of them will have spent 20 years or up, will only have advised on their area of expertise. They will never have advised on any other element of business. So you might get great corporate advice from somebody drawing up your shareholders agreement, but they would never tell you to gift shares and put in a clawback, as we often advise, because they don't give tax advice. The average small business owner should probably talk to 8 different professionals for every single decision they make. But if they talk to them, what would you find? That their advice conflicts and that you get very different advice from a tax advisor or from the employment person telling you to sack the member of staff or from the corporate person telling you that you've got problems with their options. You are often left holding the baby because professionals will not talk to each other. They will only talk to their client. And that means that rather than just knowing how to run your business, you need to know how to run professionals. And that's hard. But be very conscious of their failings. They are not, you need to be. The partner model is also very bad in that you'll often think that you're hiring the partner and find that a junior is doing the work. And the other problem is that often when you instruct them, you'll go to different firms for different things. So they're not getting any shared intelligence. They're not getting increasing and deeper knowledge of your business. So what are the solutions? And this is as much about running your business on a day-to-day basis as it is about professionals. You need to ensure that the professionals you're talking to are properly instructed. Are they interested in your business and do they understand it? Because if they don't, they cannot advise you properly. The instructions need to align with your goals. You never just need an employment contract. What you want is a good, solid basis to get the most out of probably one of the biggest investments you'll ever make, which is a member of staff. And anyone that doesn't view that holistically, you should not be speaking to. You need to make sure that every piece of the jigsaw fits a wider plan. Why the hell is somebody delivering a share option scheme for you if they don't absolutely understand where you want your business to be in 5 years' time? There's absolutely no point asking them or paying them to do it unless they comprehensively understand where that piece fits in the jigsaw, and better still, can advise on the jigsaw as a whole. And most importantly, any professional that is telling you appropriately what they're going to do for you should be giving you that advice, especially their proposal, inputting into an integrated steps plan with broad strategic and holistic understanding of you and your business. Why? What is this person doing? How does it fit into where you want to come to? What is the end result that you want? It's almost never just the piece of paper that you're writing on. It's almost never just the shareholders agreement. And that's why these pieces of paper consistently bite you when it's time to rely on them. So that's a very rapid tour through all the things that I hope are consistently whizzing through your head when you think about the structure of your business and how you develop your business, not just when the money's coming in, but right the way through to building it and exiting it.
Brilliant. Thank you very much. As you say, there's a whistle stop, but a lot of value in there. And I think probably a mix of stuff which is made people's eyes open and think, that is is maybe something I need to think about a bit more deeply, and probably stuff which feels very far off in the future. But I guess to the point you're making, of course, is that a little bit of work done today can save a lot of work down the line. We're going to open up for any questions, and if you do have a question, you can use the Zoom interface. I think it's under. I never know where it's under. But you can stick your hand up under reactions. I think that's where you do it. You raise your hand and we'll come to you. Just while you have a quick think of or gather your thoughts. This is obviously part of the StoryCube growth series of webinars. For those of you not aware, Michael and I run it's a business, obviously, but it's really a framework called StoryCube, which helps businesses explain what they do, and in a different way entirely from the way James has talked today, set some of the foundations for growth in your business and get you understanding what you want to say, rather than in this case the practicalities of maybe how you want to go ahead and achieve it. I'll throw you a question though, James, while we wait for anything else out. I think always quite a useful one I like to ask is, what's the thing that drives you crazy? The thing that is so easy to do that nobody seems to get their head round, that every time you look at it, you just want to scream.
So this is why I started the business. It's people who've spent a lot of time and a lot of money on getting really good advice, but in the context in which it's needed, it's terrible advice. And I built my own business when I was at school. I sold it. I then moved on in the dot-com boom to advising a lot of people that I was introduced to basically build, scale, and tidy up, and then exit their businesses very quickly. And so I started hitting a lot of professionals and just getting very frustrated at principally the siloed nature of their advice. It's not their fault. This isn't an attack on professionals. It's what they're trained to do. Focus on what they know and only advise their client, which is the person sitting in front of them. So after getting more and more frustrated, I started hiring my own, and I didn't intend to create a law firm and an accountancy firm, but that's very much what we ended up with. And the thing that still drives me is we can get some very, very big companies coming into our door, some that will turn over 10, 20 million a year. And it's the same problem. They took advice, and nearly everybody takes advice, and they had the shareholders agreement, but nobody thought to say to them, might you need a holding company in the future? A really classic reason for a holding company, and this is where it can save you a lot of money, is the US. Nearly every one of our clients aspires to be national, transatlantic, global, and some of them pan-European, but we find that generally is the last because of the language barrier, if nothing else. The minute you go to the US and establish a presence in the US, and the minute the US becomes the majority of your income, you can become subject to US taxes. And that is not at your discretion, it's at the discretion of the IRS. So let's go back to our sweet shop. They start selling sweets in the US and suddenly find that more than 50% of their income is coming from there. And because they didn't have a holding structure, that means that you're potentially having to report on all your business activity to the IRS. And America has much higher corporate taxes than we do. So again, just as a tiny example, anyone looking to trade overseas should always do so through a subsidiary to protect them, to isolate them, but also to simplify their tax affairs. Imagine if you come to the point of your dream exit, you're being offered millions, and suddenly up pops the US taxman and says, we think you owe us a fortune. Or more importantly, you're more likely to have in the documentation a warranty that all your reporting is up to date in all the territories you're in. And suddenly you realize it's not. We see sales consistently being slowed down by years and years and years on that problem alone. And there's many, many others.
Yeah, fantastic. And I think the thing is, there's obviously elements of it which are, for want of a better word, scary. In the examples you've just given there, you get down the line. But of course, like so much, I use a completely different analogy, but your health or something like that of your own being, that the hamburgers, the lack of exercise, the lack of sleep, the whatever, is what has contributed to the situation. And actually that stuff is not complicated to resolve if you resolve it at the time. And so I think I'm often saying to people in my own line of sort of giving advice, which I you make a good point, and I think we do try to be clear to people that you will want to get other perspectives on this and make sure that you're getting things. And we'll probably send people your way, James, for some tonic on that regard. But is to say, like, you need to take a step back and just sort of think about what it is you're trying to achieve as an outcome, but what can you do today that is going to make your life easier in the future. That is the fundamental. Do we have any questions circulating in the midst? I see someone put their camera on. I don't know if that was just to show off their looking good. Yeah, do you want to go for it? Have you got a question? Feel free to unmute. Yeah, and ask away.
Hi, can you hear me?
Yeah.
Perfectly.
Hi, hello, Robbie and Michael, and thank you very much, James. That was a fantastic talk. And I own QuickClass, and we are a software company working in e-learning, and we create apps. And really, for each of our clients, we almost set up a contract, obviously, with them, which is very much like a joint venture, but not really a joint venture. But you've raised a lot of questions in my mind about creating a holding company to hold the technology and the IP of the technology, and then literally, if we were to take the advice to an extreme, we would be creating a new company, a subsidiary for each and every client we work with. I mean, in what cases would that be overkill in your mind? Or would you have to sort of look at the terms of the customer agreement or the partner / customer agreement we come up with each client?
If what you're doing is broadly the same, and most importantly, if somebody wanting to buy it would want to buy it all in one bucket, you don't need to create more companies. Right. If, on the other hand, you have your contracts and then you develop a licensable software package that other companies can use, and, for example, you're building a lot of client data that you want to start using in different ways, I think you should have 3 companies. Why? One is what you're doing at the moment. The licensable software package would probably have a different buyer. You're likely to be seeking more R&D credits on it, so it's much easier to silo those. You're probably going to employ people specifically for that aren't going to be used elsewhere in your business. And then just going back to the example of, I'm sure it isn't relevant, but say you wanted to use the personal data of all the people who are signing up for your courses, you probably want to do that in another company because you've got GDPR restrictions and you'd want to make sure that what's going on with that is siloed and properly looked at. So I guess my answer would be the minute you start to do an activity that is different in a regulatory way, or that somebody might want to buy separately, or that has to be covered by different contracts from the rest of your business, you should probably look at doing it through a different subsidiary. And the key one is, might I need to kill this, or might somebody want to buy it separately? It's risk and reward. If the answer to those is, I might need to chop it off, either to sell it or to give it a burial, do it in a different company.
Right, that's excellent advice. I really appreciate it. Thanks very much.
Pleasure.
It's great food for thought. That's
really pleasure. And your line of business is the one that we see the most, where it becomes more and more like spaghetti, because you develop a great piece of software, you start to take on contracts, you start to bring in, you take on investment, you get employees in, and 5 or 6 years down the line, somebody goes, well, you need a holding company because now you're going to start trading in the US or the EU or wherever it is you're going to do it, or you're going to start licensing something out. And trying to unravel that spaghetti of which employees do I need to move? What software am I moving? What assets am I moving? Do I need tax clearance? It suddenly becomes quite complex. Whereas if you'd incorporated right at the outset with a holding company and an operating company, you could have just hung things underneath without any question about where the ultimate value sits. So your whole business model is really the reason I'm giving this talk today, because we hit so many entrepreneurs like you that have taken great advice, but always in isolation, never about the holistic whole. And by the time this becomes a headache, we'll probably be too late.
It's particularly interesting about what you say about international. Say we engaged with the clients who were UK based, but they had international operations. Would that also be cause for isolating and creating a holding company structure with all of our clients under one holding company, and then this one client who does a lot of international business under the other holding company?
So I'll give you a totally random example. One of our clients used to be the biggest fancy dress company in Europe. I say used to be because unfortunately not many people bought much fancy dress during the lockdown. And they sold everything from the UK. And the second biggest market for them after the UK was Germany. For some reason, the Germans love dressing up. All was going well whilst they were booking the sales through credit card terminals in the UK. But the Germans started complaining that it was an international transaction and they were having problems with their bank. So what did they do? They opened a bank account in Germany. Over 8 years of trading, they had unwittingly been subject to German VAT because the transaction was happening in Germany, not in the UK. If they had that in a separate subsidiary, their options would have been much greater than having it in the single trading entity that they had. So it's not just the obvious one of if I need to sell it or other things, it firewalls you from the different regulatory issues of that jurisdiction. So I would always advise you, if you're doing something abroad, no matter what you're doing, do it in a separate subsidiary. It doesn't make sense to risk everything that you've built through one company where everything is integrated and in the same place.
That's brilliant advice, and hopefully it will save us, millions in future. So much appreciated. I'll come and find you again. Once
and I do stress if your advisor sort of sucks on his pen and goes, it's going to cost you, it really shouldn't. All modern software systems can cope with multiple companies. The only increase in costs that you're going to have is you've got to do more filings at Companies House, which is a couple of £100 a year. And your accountant will need to file potentially separate company accounts. But alternatively, they can file group accounts for the whole lot, which is the same cost that you were paying beforehand. But the cost should not be huge as long as you're super clear about what's going into each silo and just get the right names on all the contracts.
To wrap up, I suppose, as we're coming towards time, on a sort of very practical note, because maybe this is a question that is more generally useful. If you've gone far down the line and you just have the wrong structure, is there, I'm assuming the only way out of that is a lot of money on accountants, lawyers, whatever other professionals to unpick it, or is there a sort of nuclear option to sell out, sort of, I don't know, palm something off and blow it all up and start again?
There are, and straying into all sorts of fields here. So let's look at the fancy dress company where they suddenly wake up to some horrendous problem. You can restructure and move the liability so that you firewall the liability. So they could have moved that part of the business into a separate company and declared the liability from that company. There's the nuclear option of insolvency, so you can effectively restructure your business using insolvency law, and that doesn't necessarily mean liquidation. There's lots and lots of routes in insolvency that you won't regularly come into contact with because you generally only read about insolvency when it's the end of the line. So there are lots of things that you can do, but this is back to the problem I was describing of integrated professional advice. Let's take that fancy dress company. If they wanted to restructure, you need an employment lawyer, a tax advisor, insolvency advisor, and most entrepreneurs aren't going to do that. They're going to go to their classic single advisor who will advise them from his perspective or her perspective from their silo. And that's really why I labored so much. You've got to look at the professional and think, are they actually able to give me this advice? Because normally the answer is no.
Okay. Well, I think that's a strong word of caution and a rule of thumb almost, to kind of take forward and go through. As has been mentioned, I think in the chat and previously, and whatever, the slides and things from this will be shared with those of you that have signed up. I am sure that James would be, and his colleagues at Dragon Argent would be happy to hear from you if you've got any specific questions. So what's the best way to get in touch with you on things?
Straight to our website. There's a contact me function, and I love phone calls with problems. So
there you go. Michael's popped some links into the chat as well. But yeah, just goes to say a huge thank you to you, of course, James, and I know the rest of your team who've been putting this stuff together, which is great for us, and to everyone for coming. Of course, it is, as was described just before we came online, as the dead week of the summer. I know those of you with kids and whatnot are probably about to roll back into school, or if they haven't already. I'm actually up in Scotland, so they've been back for ages, hence the huge COVID spikes, and everything else that you're all getting on with. I hope it's going on. We'll have more of these month by month, really, or even more often if Michael gets a bit carried away and excited with potential guests. And we look forward to hearing from you. But thank you for everyone for coming along, and we will hopefully see you again soon. Have lovely days all. Bye-bye.
Thanks so much. Thanks, guys.